Hey guys, so in today's video, we're going to be talking about some of the lessons that I learned from Warren Buffett and lessons and quotes that I think you can take away to begin investing today. Lesson number one, investing shouldn't be complicated. Pretty much the idea is you want to keep investing really simple. So one of his quotes is, the business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. A lot of people get so caught up with investing and, oh, it's super complicated and I have to be able to study this or know that and do this and do that. I mean, there's really just a handful of things you really need to know before you start investing in businesses, right? In the great words of Michael Scott, you can always think, keep it simple, stupid, right? Like, there's no need to overcomplicate investing into a company. You want to look at companies that you sort of understand and can just wrap your head around. That's why with Warren Buffett, he's a big investor in Coca-Cola. He likes it. It's simple. It's just a beverage company, and he loves the brand. And I mean, they serve over 1.8 billion servings of Coke every single day, and he loves that. He loves, if they were to raise it just one penny, they make over millions of dollars because they serve over 1 billion servings a day. See, and it's just a simple company that he knows to invest in. So he recommends that when you're investing, just invest in a company that you find simple and easy to understand. By the way, if you're enjoying the video so far, please make sure to hit that like button and don't forget to subscribe down below if you haven't already. It really helps out the channel. So that leads us to our second lesson, and it's to invest in things you know. So another quote to look at, it never bothered me if people disagreed with what I thought, as long as I felt I knew the facts. I mean, there's a whole bunch of things that I don't know. I just stay away from those, so I stay within my circle of competence. You just want to stay within things that you really know. So for example, Warren Buffett loves food. He likes candy, stuff like that. That's why his personal stock portfolio is just one company, Coca-Cola. He loves soda, and he drinks their Cokes almost, I know, every single day, and at least a handful of beverages a day. With me, I'm not too into, medicine and medical stuff. I'm not really competent in that. But I am competent in more like finance and technology. So I'm really big into investing into bigger companies that are in technology and finance, right? Businesses, banks, stuff like that. But you'll probably never see me invest into like some sort of medical company or anything like that because I don't know anything about it, right? Another great reason you want to invest in things you know is so when you are investing, you better understand what you're investing into and the business that you're investing in. Again, if you don't know that much about the medical area, then when you invest your money into that company, you don't really know how it's being used or where it's going towards. Whereas if I were to invest in more of a technology company, I know the research and the areas that they want to invest in are, right? I'm better able to understand it. And therefore, when you invest, you're better able to understand the companies and businesses that you are actually directly investing in, because you know where they're either going to allocate the money or their goals in the future that they want to continue to push and innovate. Another simple quote that falls within this invest in things you know, one of the 6 criteria that he looks for are simple businesses. This is a quote from Berkshire Hathaway's 2014 letter to shareholders. So Warren Buffett, he's famous for not investing in a lot of the tech companies back in like the 2000s, like Amazon or Google or Apple or Microsoft, right? Because to him, he likes simple businesses, just companies that he's better able to understand. And he is a bit older. He doesn't really know that much about technology or Microsoft and Apple and their businesses. He's not really that into technology. So he just invests in foods and stuff like that he really enjoys. He also likes banks, so he invests in banks, but he doesn't really invest in a lot of the tech companies because he just doesn't know it. Now, a quick little disclaimer, Buffett did recently invest into Apple back, I think it was late 2018, but to him, it wasn't necessarily a technology investment. He saw it more as a consumer behavior investment. He noticed that a lot of his grandkids were always on their, doodads, their iPhones, and they were just addicted on just staying on their phones. And he noticed the behavior of humans, how we're always on our phones constantly. So he saw it as, well, people are always on their phones. He knows how to study consumer behaviors. That's why another big thing he's very known for is he likes to invest in big branded companies like Coca-Cola or Kraft Heinz, for example, right? These really big brands. He really understands that area of businesses. So that's why he did end up investing in a well-known company like Apple. Lesson number 3 is that there's a difference between traders and investors. Calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. So I really enjoyed that quote. I thought it was pretty funny. But I mean, it's true, right? So there's a difference between investing into a company. Hey, I'm going to take X amount of money and I believe in this company for the long term, versus someone more short term that's just trading, where let's say the same $10,000 into this company, and at the end of the day, I hope it makes a nice surge. And once you have that surge, since you've made a profit, you just go ahead and sell out. That's not really investing, right? It's more gambling. You're just wishing and hoping that this company does well so you can make more money. Whereas with investing, you put your money in, and in the long term, in a couple years, you expect that the company will go ahead and bring you a greater return on your investment. That leads us to lesson number 4, where investing is a long-term game. Buffett is very well known for stating, our favorite holding period is forever. So when he invests into companies, he expects to buy them when they're really undervalued, and then just let the money sit there and let the company keep doing its thing. So in the long term, it's able to produce more money, and he's able to profit on the initial capital that he invested into the company. So if he really likes and enjoys the company, he won't really ever sell any of his money. Now, I know you might be thinking, well, then how do you ever really make money? Well, one, you could either start selling a small percentage of your profits, or two, and Buffett is also known for this, where he likes to invest into companies that give you dividends, right? The idea with dividends is, if you invest into a company, after let's say a year, a company's made so much money and a lot of profit that they're, you know what, I want to go ahead and give some of this profit to my shareholders. And so you get, let's say, $1 back because you are a part owner of that company. Lesson number 5, you can't time the stock market. Now, there have been many studies. I know Graham Stephan did one where he looked at when people invested when it was like at the top of the market, as well as when they were on the bottom. And you notice that there really isn't that much of a difference from when you invest at the very top or at the bottom, or you just invest as you get capital in, right? Either from your job or side hustles or stuff like that. Now, Buffett's quote on this is, you're making a terrible mistake if you stay out of a game that you think is going to be very good over time because you think you can pick a better time to enter it. So now, nobody, and I'm talking nobody, not even the Oracle of Omaha or some other person that's investing in the stock market, nobody knows whether the stock market's going to go up, whether it's going to go down, whether it's going to go sideways, upside down. Nobody knows the movement of the market. But then the market becomes overvalued, right? And then vice versa. When people start getting scared and they want to jump out of these different companies and out of the stock market, that causes the market to plummet, and nobody's investing in the stock market. And now that's when these companies are undervalued. And that's when Buffett actually prefers best to invest his money into, when people are really scared. He says, I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or even a year, I've never felt that I knew it, and never felt that that was important. Again, a lot of stock market investing is just investors' behaviors, right? If people get scared about investing in the stock market, it's going to plummet. If people get super excited, it's going to go skyrocket up, right? So it really depends on the behavior of other people investing in the market. That's why in the long run, it's better to just take your capital and invest over a long period of time, instead of just waiting for it to either go up or to go down. Just consistently invest, let's say either weekly or monthly or whatever's good for you, where you can continuously keep buying a little piece of the company every single time you have some capital. Then, because remember, investing is more of a long-term game, you're going to see your investments bring in money over this period of time, and they're going to continue to grow. You just got to stay patient. Lesson number 6, don't get emotional. Some people should not own stocks at all because they just get too upset when price fluctuations occur. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. Again, with the whole idea of nobody knows where the stock market's going to go, you don't want to get super emotional when you're like, yeah, the stock market's going up, or, oh, the stock market's going down. Let me get out now and try to save some of my capital. When you invest in a company, you're really just investing into a business that hopefully you understand at this point. So you know that in the long term, it's going to go up, right? Again, with Coca-Cola, he knows that people are going to continue to drink Coke, right? In the long term, no matter what, whether, there's people drinking less of it, he knows that in the long term, they're going to continue to innovate and create either new drinks or be smarter with the way they serve their drinks. But in between those different time periods, you don't want to start getting scared just because you see the market tanking, right? Once you've invested in the company, you know wholeheartedly that the company is going to do well, right? And you leave out all that emotion because you've done the studying and you've looked at the financial statements, and you know the company is going to do well over a period of time. Now, a quick example I've seen of this directly is with Elon Musk and Tesla. I don't remember what year, I think it was 2016 or 17, he went on the Joe Rogan podcast and he smoked, which it was legal in California, so he didn't see any issue with it. And that same day, the Tesla stocks went down over like 10%, right? People got scared. They're like, oh my gosh, what the heck, right? But in the long term, they're doing fine, and they've more than 10x their stock prices in like the last year alone, and it's been crazy. So when you invest into companies that you know are going to continue to innovate and just continue to grow, there's no need to be emotional and worry, right? You know you've invested in a very solid company. Lesson number 7 is to take advantage when others do get fearful. So despite the fact that he preaches that you shouldn't be fearful when the stock market goes down, as long as you've invested in very solid companies, there are going to be investors who do get scared, second guess their investments, and try to jump out of their investments as soon as they see something go bad, right? But this is actually the time when markets tend to be completely undervalued and you can get these businesses for super cheap, right? So we'll take a look at this quote where he says, during such scary periods, you should never forget 2 things. First, widespread fear is your friend as an investor because it serves up bargain purchases. Second, personal fear is your enemy. It will also be unwarranted. Investors who avoid high and unnecessary costs and simply sit for an extended period with a collection of large, conservatively financed American businesses will almost certainly do well. The idea here is that when you see these, a lot of people become fearful and the stock market tanks, that's actually probably the best time you can ever go to invest into a business or into a company. Again, as long as you know that this company is going to continue to innovate and continue to grow in the long term. You always want to be thinking in long term, not the short term. Buffett is also known to be a contrarian investor, which is pretty much when others are trying to jump out and flee the stock market. That's actually when he tries to go in and pounce on the stock market and invest a lot of his capital. And vice versa, when a lot of people are cheering, oh yeah, stock market is doing great. Let's say the tech bubble, right, in the 2000s, when everybody was cheering on the tech companies, and then it popped, right? So he doesn't believe in jumping into companies when everybody's saying to invest. Another quote to look at is, be fearful when others are greedy, and greedy when others are fearful. Lesson number 8 is that when you're buying a stock of a company, you're actually buying a business. The quote to look at here is, Charlie and I hope that you do not think of yourself as merely owning a piece of paper whose price wiggles around daily and that is a candidate for sale when economic or political events make you nervous. We hope you instead visualize yourself as a part owner of a business that you expect to stay with indefinitely. When you invest, you don't want to look at it just as, oh, I own a little piece of business. You want to look at it as, I own that entire business. How much would I be willing to pay for that entire business? And then from there, you go ahead and you start buying stocks. That's what Warren Buffett does. He takes a look at the business overall as an entire company, and he says, I would pay $1 billion for this company, but the company is currently worth only $900 million. So from there, he knows that it's undervalued, and he goes ahead and he tries to buy as much stock of the company as possible. Buffett also uses his farm term. So you can think of it as when you go and if you were to buy a farm, and this farm has chickens and cows and creates all these goods for, people around the world that people can come and buy. This farm is producing eggs and it's producing milk. You can go ahead and sell these products and it's going to continuously make you money. Now, you don't go ripping your hair out just because, chickens decided not to roost as many eggs as yesterday. In the long term, they're going to continue to produce goods, and you're going to be able to continuously make money from those goods. Lesson number 9, you want to invest in companies that have moats. So to quote Buffett, the nature of capitalism is that people want to come and take your castle. If I'm selling television sets or something, there's going to be 10 other people trying to sell a better television set. So capitalism is all about somebody coming and trying to take the castle. Now, what you need a castle that has some durable competitive advantage, some castle that has a moat around it. Now, there are a lot of different companies out there, a lot of companies that make the same thing. Like he said, television sets, you can think of it simply as soda, right? Different types of cola, right? You can think of Joe's Cola versus Coca-Cola, right? Most people know Coca-Cola, the brand Coca-Cola, and would much rather buy a brand that they trust over some knockoff brand called Joe's Cola, right? So they're willing to pay that extra, maybe a couple cents more to get that really nice brand that they know and trust. Lesson number 10. The best moves are usually the most boring. You won't have interesting cocktail party stories to tell about your boring companies like Procter & Gamble, makers of diapers, soap, toilet paper, and toothpaste. However, companies like that are often the best in their business and that can provide excellent long-term returns. Notice here, it's not about making a quick buck, right? He mentions again, long-term investment, a long-term return on your investment. So these companies, because they're going to continue to keep growing and continue to sell their products, they're going to continue to also make money. Bill Gates is also known for actually investing in trash. He actually invested quite a large chunk of his portfolio in waste management company. Now, it might not sound, the most fun to invest in, let's say, waste management over Tesla, right? Tesla sounds so much more exciting. But in the long term, waste management, we're always going to need a company that takes our trash, right? So they're always going to be like a necessary company in the United States. So that's why with Bill Gates, he would much rather invest into waste management company where he knows that it's going to be consistently growing over a long-term period. Lesson number 11 is investing in index funds works. With this quote, he says, looking back since 1942, when I bought my first stock, we have had all sorts of things. We've had world wars, 9/11, Cuban Missile Crisis, and all kinds of different things. The best single thing you could have done on 1942 was just buy an index fund and never look at a headline or think about stocks, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you, and you get your money. So this lesson is very important for people who don't really know either what companies they want to invest in or just think it's too much work to do, right? You can go ahead and just invest in an index fund because now you've taken this large pool of different companies that are making money for you. They might not make as big a gains as, let's say, picking specific companies. But again, over the long term, they're going to continue to grow and continue to bring more money back into your pocket. Lesson number 12 is to never stop learning. Buffett's quoted as saying, I just read and read and read. I probably read about 5 to 6 hours a day. Now, yes, reading 5-6 hours a day might not be obtainable for some people, right? Some of us have to work, we have school, we have this, we have that. But if you can just go ahead and try and learn just maybe 1 to 3 things every single day, over time, if you're consistently just learning every single day, you'll have learned 21 different things by the end of the week. You've learned 21 new things that you didn't know the week before. This is definitely one of those quotes that doesn't just apply to investing, right? This applies to everyday life. As long as you're continuing to better yourself and continue to learn, you'll be a better thinking person and you're better able to make decisions as you go along in life. Now, these are just some of the quotes and lessons that I personally learned from Warren Buffett. And yes, there are plenty more that I've learned from him, but these are some of the big key takeaways that I took from studying from him and studying his books and studying the books that he recommends. Well, I hope you guys enjoyed taking a look at some of the lessons I learned from Warren Buffett, and I hope there's some lessons in there that you're able to take with you. I hope you guys enjoyed today's video. Thanks for watching.